Welcome to the Crypto Compliance Podcast by Gatenox.
Pawel Kuskowski, welcome in Crypto Compliance by Gatenox, where compliance experts and practitioners are talking about current market events and general compliance aspects. Today I'm here with Benjamin Whitby, who in my mind is one of the top people in compliance in crypto Web 3.0 space. Ben, you have unique perspective because of your experience in traditional finance, compliance, and AML, crypto, and now Web 3.0. So let's start with our main topic, which is how relevant you think is your experience in traditional finance and shifting over to first crypto, because we met actually in 2018 when you were in Token Card, now Monolith. And then you moved into Credo, correct?
That's right, yeah. I mean, first, thank you for the kind words. I'm a bit of a weirdo in terms of kind of being so early into this space when same as you, right? When we were kind of faced with the compliance consortium and compliance colleagues that were saying crypto assets were bad and Bitcoin was bad, etc. It's just like, no, we need to explore in this space and keep building because it's going to be the future. So, you and I both saw that early, and coming from the traditional financial world, it's hard to try and get people to move away from the status quo, but it's important because that's how we progress. It's how we change.
Yeah, I remember, this first time, I think it was a little bit easier because there's still applying basic rules to this ecosystem and trying to figure out what we need to do, right? And, some experience which you brought from what was with HSBC, right?
Yeah, that's right. Yeah. 8 years at HSBC. Prior to that, 3 and a bit years with PwC, where we did Lehman. Prior to that, with Accenture. And then prior to that, I was a dev and I used to build trading systems. And I built the world's first interest rate swaps trading platform back in.
So how did you move from trading to compliance?
I mean, I just found that I was just using the skills that I have acquired at university to kind of suck in vast amounts of information and screen lots of different data and just consolidate that into a workable framework. When we built SwapStream, it was a case that was with the FSA back then. And it was a case of, right, here are the market rules. This is the tool set that we need to build. We needed to build to the line so that we didn't go into anything that we weren't allowed to do. So we had to understand the tool set. So yeah, I went down the first kind of FSA handbook and did what compliance experts take a couple of years to do. I had to do that in 6 weeks.
Okay, so you've been fresh in terms of, so you immediately started almost with okay, there's something new and we need to build framework for this, right?
Yeah, and then kind of from there became something that was clearly valuable in the community, right? In terms of traditional finance, because the regulations, they keep coming back, they keep coming out, they keep extending, and sometimes it's not about evolutionary change. Sometimes it's about radical change. So when MiFID came out in the first time, 2004 to 2007, I built a team in Accenture that we grew to about 160 consultants that went all over the city, all over Europe, actually, kind of putting different delivery positions in place. And I did that with a guy called Tony Kirby, who's now one of the regulatory partners at EY. And yeah, then I took that and then moved it on to PwC, where I got first-hand experience of Lehman's going into collapse and seeing what FTX is going through now. It just brings back all sorts of memories, because the team that did Lehman Brothers with PwC was the ex-Enron team from PwC that went in 2008. And now the ex-Enron team from the US is picking up the FTX administration.
I remember, myself, when I was in London 2008, and Lehman collapse was happening. There was bizarre place to be at that time. People like flying with, notice to stick to the wall of Lehman Building. That was really interesting stuff. Yeah, I mean, there's definitely, this is good. I think reflection of what's happening not so long time ago, right, in traditional finance, and what's happening right now in crypto.
Well, you say it's not that long ago, but you think about 2008. It's like 14 years ago now, right? It's two cycles. It's two market cycles. I mean, people say that traders last between 7 and 10 years on the floor. So there will be people that are on the floor today that have never experienced Lehman downturn. They've never experienced the high interest rate environment. They've never experienced a cycle in traditional finance, let alone crypto. I mean, and crypto's on another level in terms of the volatility, the cycles. This is my fourth bear market now in crypto. So yeah, it's brutal.
And I remember, when I met first time you in Monolith Token Card at that time, I think you've been right after ICO, correct? That was the time
Correct.
of ICO 2017, 18. And I remember, when we first talked and I said, okay, this guy knows his stuff, right? And there was like not so many people at that time who I could say, all right, I think there's like a few on the market, right? So things changed since, right?
Yeah, absolutely. I mean, and I think it was different because I made it my kind of, I saw what was happening with Bitcoin. I first went down the rabbit hole in Bitcoin in 2013, and that was with HSBC. And somebody in Canada, one of the bankers in Canada, put 50 Canadian dollars into the RoboCoin ATM. And Wired was there, and they wrote in a report, and it was like HSBC Bank who invests in Bitcoin. And that hit our negative news, went straight up to Stuart Gulliver, who was the CEO at the time, and landed on my desk about 30 seconds later. And it's like, right, I need to understand about Bitcoin. It looks interesting, but what does it mean? And then when you go down that rabbit hole and you say, okay, this is the world's first digitally scarce asset, and you can start applying that logic to bonds, to equities, to stocks, to anything that we do in capital markets. You say, right, digital assets are capital markets 2.0. I need to know about this. I need to understand it. And then it wasn't really until Ethereum launched in 2015 where that was kind of really the game-changing market for me. Because Bitcoin is kind of interesting in terms of we can do peer-to-peer value with it, but the smart contracts, the DeFi, the ability to do more programmatic transactions, that's a real game changer.
All right, that's a good point. So what brought you actually to crypto in the first place? I personally myself, I saw that the most fascinating part was the ledger, the open ledger which you have, and that you can analyze this. And at that time, I was actually with Royal Bank of Scotland, right? And I remember problems which, RBS had in terms of analytics. And I said, like, listen, if we can get, this data, right, and we can start playing with this, we can create really the sandbox for future, regulations almost. So what was your story, which kind of hooked you up to crypto?
It was really similar. So after I went down the rabbit hole and I sorted this guy out that like did the RoboCoin thing, I kind of walked him around the car park and came back, and it was just like, right, we need to do more research into this, do more work. And at HSBC, it was like, okay, well, first of all, we need a policy. So I wrote HSBC's very first policy in Bitcoin, and that was all about blockchain, not Bitcoin. So, everybody was very excited about blockchain, about what it could do. And we can't say blockchain, so let's say DLTs. And I just sat there and I'm watching all these people running around getting really excited. And I'm just thinking to myself, you guys are just making all of the same mistakes that we made the first time around when Internet 1.0 came on. Because when the Internet first came out, I was at university, and I remember people running around and going, oh, yeah, the Internet, public, open is far too scary. We can't do that. But we can get really excited about the technology and do intranets. So we can email each other inside the company, but we can't email outside the company. That's far too risky.
So you still remember this time, right?
Yeah, I was hearing all the same arguments. And it's like, how are people not realizing that open always wins, right? Eventually, we always get to a position where it's like, I need to be able to talk to you. You need to be able to talk to me. Open always wins. It just takes time for people to get there. So yeah, I tried to move the needle inside HSBC for about 3.5 years before I just lost patience. And then the ICO boom happened and there was a load of money on the table. And the guys from Token Cards said, look, Ben, we're looking for somebody that understands compliance and crypto. And you seem to be it. So I said, yeah, I'm in. Which was great. It was great to move there. You know, we got into the FCA sandbox. The FCA were great. But it was a retail swipey card, right? And my background's capital markets. And so I had this big vision of doing this other thing. And there were things that we did at Token Card that were really frustrating and limiting because the tool set didn't exist. And so that's really what I decided to kind of move on and make sure that I could build some infrastructure so that other teams and other founders could come behind us and start to kind of apply the same kind of corporate governance to their crypto assets that you need to in a traditional financial model.
In terms of replicating, you know, what was in traditional finance, did you apply like policies, procedures one-to-one into crypto world? You know, what did you find different? What did you find the same? What type of, you know, if you remember, you know, what type of, let's say, thinking you had? I remember, you know, like, you know, one thing which was striking for me from the beginning was that actually, you know, the AML rules gonna apply. No way you can run away from this, right? This is like 100% is going to happen, right? Because we're talking about assets and value transfer. And that was, for me, you know, another question, whether we have rules which are sufficient and which are applicable. And almost from the start, I'm always saying that we have sufficient rules, right? We just need to, there's this another asset class and we need to apply this, you know. So that was kind of, for me, it was interesting, you know, during CoinFirm, you know, when we were actually, you know, figuring out the whole AML stuff.
I mean, nothing really needs to change that much in terms of the rule set when you're talking about this new asset class. Nothing really needs to be changing too much as it stands. I think the changes that have been brought in have actually come too far. Because it's pretty limiting in terms of, you know, I would love a position where two graduates come out of uni and they want to set up a company, and across Europe we put tools in place to say you can set up a company really quickly, you can get a bank account really quickly, you can get into business really easily. It's about minimizing that red tape, which is great if you want to sell pictures of monkeys, right? If you want to sell pictures of monkeys on a market stall, you can do that in 7 days, pretty much all across Europe. You can get a bank account with HSBC. Yeah, we're going to sell art. You can get a stall in a marketplace. You can paint your pictures. You can do everything you want. As soon as you turn those pictures into digital, oh no, you need to go and get regulated by the FCA to do that. And it's like, what are you talking about? We're just two graduates out of university painting pictures of monkeys, right? Of course we don't need to go and get regulated by the FCA. And it's like, oh, yeah, you definitely do. Oh, it's like, okay, tell us why. Well, because they're a crypto asset. Because you've turned something that's physical into something that's digital. You all of a sudden need to be regulated by the world's most stringent regulatory framework, by all individuals that should be looking at global systemic banks. It just doesn't make any sense to me.
Actually, that's a very interesting point. So why do you think? I mean, when you said this in this way, I never thought about this in this way. Actually, but it's a picture. So why do we? I mean, we can say that the AML still apply to art the same way it applies to anything else. Yeah.
As soon as it hits over €15,000, it becomes a high value good, right? Then yeah, absolutely, AML starts to apply. So why don't we apply the same kind of logic to something that's digital? If I want to sell you a pen, right? I can sell you a pen. I can sell it to you for £5. If I want to sell you a digital copy or a picture of this pen, I should be able to sell you that for £5. If this pen becomes something that's antique and like £30,000, well, then maybe that's a high value good. So maybe we should do some AML and do some kind of normal type of real world type of activity on that. But there's no way that just because this pen is digital and it's worth £5, and because it's digital, I need to do KYC with you. That's ridiculous.
Okay. But so you saying that. So why did we got into this place? How did we got into this place?
I think it's fear. I think it's lack of understanding of the technology. It's regulators trying to attack the technology. It's a really limiting factor. I mean, I was having a conversation with HMT a couple of weeks ago, and they're like, "Man, we've got really good kind of framework for digital assets. We're very happy and we're very comfortable with that." And I just said, "Okay, well, in your life, most things are digitizing, right? Music is digitized, movies have digitized." Communication has digitized. When you're trying to sell all those different things, you can sell those things to people that have got a Visa card and a MasterCard and a bank account. But if you enable crypto, you can sell them to anybody that's got a crypto wallet. So Netflix, if we use Netflix as an example, Netflix sells movies. It doesn't even make the movies in majority of the time. It streams them from other instances. It sells a subscription model for people to access those movies to target total addressable market of 2 billion people. 2 billion people in the world have got crypto, have got a Visa card or a MasterCard or a bank account. There are 8 billion people in the world. So if the governments allow crypto as payment, Netflix can go from a total addressable market of 2 billion people to a total addressable market of 8 billion people. Now, that's going to put growth into Netflix. That's going to put all sorts of different things and opportunities into that marketplace. They just need to be less fearful of crypto and understand that small payments to facilitate small goods is just business. It's not actually anything to do with crypto at all.
But I think one of the biggest challenges to explain, and also I think the market participants which are in crypto are not helping, right? And we need to be honest about it, right? We know
absolutely.
So many, and sometimes I'm like, even myself, I'm saying like, oh my goodness, like it's going too far, or it's like this guy is just SBF situation. This is ridiculous. I think we are getting into the place where it's a little bit too much, and there are normal people hurt as well, during this process. Like people who don't, because like many people in crypto would say, oh, you just put your money and you lose you win, you lose, right? But at the same time, if you got early to crypto, right, you may have this type of, because suddenly you had like, I don't know, hundreds of thousands or millions in crypto, right? And, this just happened out of nowhere. And you have other group which is coming with the real money and putting the money into this ecosystem, and they are losing real money. losing money what they didn't earn in crypto. So I think that's the one of the biggest challenge, and until that point, and it's interesting because, like from marketing perspective, you almost promote one product, Bitcoin or Ethereum, right? So there's like very few. The rest is secondary. Who is selling is secondary, right? You have Crypto.com, you have Binance, you have whoever, but the entire market is just promoting Bitcoin, right? So it's like your comparison to pen is, if you would be like, get this pen, that's the only pen in the world you can write, or that's the sexiest, you're gonna be rich. The pen price, the pen number is limited, right? All this stuff, and you just promote, like you spend millions and millions and billions actually to promote this pen, right? So suddenly everyone is obsessed with the pen, right? So there's, I think it's interesting how it happened. And I totally agree with you that, there's so many things that, should not apply or could be applied differently. But at the same time, there is this feeling of, something going wrong in the crypto market.
Well, it's interesting, isn't it? I think we shouldn't conflate the challenges of human nature and markets with the obligations that regulators have. And you look again, just look at the FCA, because that's the FCA in the European market is the market that I move around in primarily. I move around in the US market with the CFTC and the SEC. Less so now. I used to do it a lot more with HSBC, especially given the Dodd-Frank experience that we had. And, the HKMA in Singapore, MAS, they're again kind of moving things. And that all happened from the derivatives market, from that 2009 paper that came out in Pittsburgh, that really kind of pushed the OTC market into the position of transparency, which was a very unregulated market before then. And we can look at the crypto market in a lot of different ways to the OTC market, the bonds market, the FX market, or if you go back further in time, various other different kind of market frenzies, market explosions, bubbles, asset bubbles, all the way through to, tulips, back in the kind of 1800s. And the market and the people will do completely crazy and irrational things. And the regulator's remit is really to do two things. It's to protect people, and it's to protect global systemic positions. Now, arguably, crypto is a tiny, tiny notional. It's not systemic at all. It's grown an awful lot more. And there's a great infographic from Visual Capitalist that has just been refreshed with the position from SBF and what they've kind of put into the marketplace. But the protection of people is something that I think the regulators need to take responsibility for. The reason that people have got burned, that have lost these assets to, let's be honest, SBF, in my opinion, is a crook. He's taken client assets and he's given and manipulated and used those funds for his own use. Now, in the terms, it's probably said that he could do that. And I think that people need to be very aware of when they're giving assets to a third party, a custodian, that they understand what happens to those assets. Now, when you give your assets to a bank, they're not your assets. Those assets are being used as part of the fractional reserve banking system. So, banks can take those, they can use those, the capital requirements of Basel, and they can print various different fractional loans off the back of that. When you give your money to an EMI, electronic money institution within Europe, it's a very different story. Your assets are segregated and they have to be evidenced kind of one-to-one. But the reality is if you are dealing with crypto assets and you're dealing with CeFi, where you're giving them to an exchange, then you don't actually have those assets. Those assets are being loaned out in some way, shape, or form. There is no way that you can earn 8, 9, 10, 15% on an asset without some other kind of rehypothecation happening. There's got to be something happening at the other end. Now, what the regulators are at fault at is, one, they've pushed all these people offshore into low regulatory environments where they should have put simple and transparent frameworks in place to enable them to actually kind of have a touch base on the organizations that are doing that. And at least that would give them some clarity and remit to actually kind of to operate if people went bad. And two, help with the transparency so that people actually know what's happening with those assets. Because if you're giving your assets to an individual and say, please make me 8% on those, you say, okay, well, how are you going to make me 8% of those assets? Are you going to sit there and let them stake? Well, the most staking that I know is about 12, 15%. So you have to understand that there's some kind of inflationary supply probably on that. And therefore, if you're not staking, then you're actually leaving money on the table, but you're not taking any risk with those assets because they're staked. Or you put them into a position where they're being rehypothecated to other people, where people can put them into the market and use them as short positions and collateral and are prepared to take that longer interest rate because they are not interested in holding those assets long time and they're actually wanting to short them or do some leverage trading on them. So, yeah, I mean, I'm actually quite angry with the regulators around the UK, the European Union, and the US for not having some kind of framework in place to protect people, because people have lost a lot of money. Real people have lost a lot of money, not just crypto geeks like Mt. Gox. This is a fundamental failure in the regulatory structure. And what's worse is that SBF was using that money to pay and lobby regulators to get what he wants in terms of a framework that would benefit him, and they were listening. So the rabbit hole goes very deep on this one. And
true.
Yeah,
it's definitely the SBF is just probably starting. What's going to be coming out from the entire problem. And I mean, I think it's sad for the ecosystem, but at the same time, there is some. I think I spoke recently with some people heavily involved in crypto, but crypto which is more Web 3.0, non-Bitcoin crypto. This type of people, and we actually agreed that, this is probably, many people are going to hate me for this, but if Bitcoin would go to $20, with all the crashes, then it would be a situation when we could ask question, okay, do we need Bitcoin or can we replace with something which is more meaningful and, wash out all the, speculative money, right, from the market. So I think this would be interesting in terms of seeing this happening. Probably there will be question if the crypto market survive in general, and it would be just tulips, right? We're gonna end up with tulips, but moving on. You right now in Credo, right? And Credo, my understanding is that what Credo is building is effectively Web 3.0 ecosystem in some way.
That's correct. Yeah.
So tell me more.
I kind of mirror the position that you kind of were alluding to. I mean, Bitcoin is amazing in terms of what it does. It's this asset class that is kind of virgin in terms of the asset class. It does very limited functionality, and that's kind of its beauty in so many different ways. But yeah, I mean, it totally could go to zero. It's only worth what other people are prepared to pay for it. When you start getting to Web3 and you start utilizing the technology and the frameworks that are around that to put digital scarcity onto other assets, then you start applying traditional economic standards and economic frameworks to this digital economy. And I know we kind of messed around and started talking about monkey pictures at the beginning, but the crypto asset framework really is just like paper. And I talk to regulators and I say this, and they look at me and say, "Ben, you're like really crazy. What are you talking about?" And I'm like, "Okay, well, it's a durable medium." And they're like, "Okay, well, that's a word I understand. So you're saying that crypto is a durable medium?" It's like, "Yeah, okay." And I go on to elaborate and say, "Okay, well, if I take this piece of paper, and what can I do with it? Well, I can put it into a file. I can put a file into a box. I can put that box into a warehouse, and you can understand how that security is stored and it's secured." And they're like, "Yep, okay, get that." And then we look at the individual piece of paper and we say, "Okay, that piece of paper, if I give that piece of paper to an 8-year-old and they draw me a picture of a butterfly, then that's something. Yeah. And if I give this piece of paper to a lawyer and they write me an ISDA contract and various different parties sign it, then that's something else. But the paper is just paper. And you can take both the picture of the butterfly and the ISDA contract and you can put them in the same folder and you put it in the same box and put it in the same warehouse and have the same level of security on it because it's just paper. It's just a durable medium, right?"
That's good explanation, definitely. So Web 3.0, what's your take on Web 3.0?
Everything is paper. Everything is paper. If you swap out the paper for a floppy disk or a DVD, it's a way of conducting and transferring this information, because everything becomes information, in a way that can be controlled and stored electronically. Now, the good thing and amazing thing with crypto assets is you can do things like fractionalize them. So you get more functionality because you can take that piece of paper and you can say, "Okay, well, I'm going to own a certain tiny part of that piece of paper." And it carries the same kind of digital asset rights. And you can start to kind of fractionalize all the payment flows off the back of that in a way that you can't do with traditional instruments. You can't take a part of an ISDA agreement and fractionalize that, whereas you can with it when it's a digital asset. But if you start expanding things into the digital world, and music and videos is a really nice one for people to understand again, because again, they've had a lot of experience with that. If you spend $15 on a Apple download, then that Apple download goes into your Apple Music library, but you don't actually own it. If you move from Europe to America, well, America has different licensing rules. They use a different Apple store. And so your Apple purchase doesn't exist in the US Apple store. It only exists in the European Apple store. So you can't access any of your music. Now, what we get with the digital position is the ability for you to say, create a unique digital thing that you can sell and you can own. So Web3 is about the next evolution of the internet, and it's about digital ownership of your assets, which is pretty amazing. And it will end a lot of the issues that we find around Google and Facebook mining our privacy and mining our activity, because we will be able to move into a pay-as-you-go environment where we're saying, "You're providing me a digital service. I will pay you digitally for what I use. And you stay out of my data. You don't look at my data. You don't watch where I'm going. I will give you the information that I want to give you and nothing else," which is amazing.
Okay, so on this, so how do you write procedures, or how do you look compliance on the piece of papers or library of paper? Where do you start, and what's your focus? Or you just say, "Oh, listen, just a paper." What we need to do is
you need to disseminate the difference between the durable medium and the content that's the durable medium actually is. So we've always been talking about how we need a taxonomy of digital assets between various different things, and we're starting to get there in terms of the various different payment tokens and governance tokens and NFTs that are coming through. And then we need to start looking at the way that organizations operate and build within them. So if you are Nike and you are selling digital shoes, then you need a tool set that's going to allow you to do that and have your marketing and your finance department manage all of that. And your marketing department might decide, yeah, okay, we're going to be taking Ether or USDC or stable coins, and we're going to take some of that and we're going to put it into a custodian, which is going to become a bank or whatever it is, if that extends. But at some point, we're going to want to say the marketing department operates. Now, the marketing department isn't going to need a bank to secure its assets because, it's just a marketing department that, you don't have the same level of stringent stuff. If you're building a high value good and that then becomes super expensive in terms of that digital asset, then yeah, you put more protection around it. But it's about scaling the level of protection to make it proportionate to the type of asset that you've got in place. Now, what we've done at Credo is we've said, right, in order to scale that level of protection, we will give you the best cryptographic tool set that you can possibly get. NASA grade, it's the best. There is nothing better than Credo on the marketplace in terms of securing assets. How you then apply your own governance on top of that is different. So if you want one person to be in control of that NASA grade technology, that can be occurred, and an individual can use this technology. But if you want a team of 17 and various different levels of sign-off, 4i, 6i, 8i, different approvals or value-based approvals, you can put that level of sign-off on that as well. So it all maps to the organizations, the institutions framework. If you needed external parties, you add those external parties in, and you build your framework to match and to map to your risk appetite and the way that you want to operate your business.
So, tough question now. What if you have, terrorist financing money on this secure ecosystem? How do you so let's say from the compliance perspective, how do you prevent it? What's the responsibility, to prevent it? What you do once you have it? This is something which we need to answer, I guess, as a Web 3.0 in general.
Yes, that's a tough question. I mean, sanctions have been put in place and they're important. You don't mess around with sanctions. They're there for a reason, and sanctions and compliance in general reflect society's representations of normal, right? An entity
I like this quote, by the way. I like this quote. I completely sign up to this.
Well, if a society rejects and disagrees with the compliance framework that's in place, they vote a new political government in, which comes in and rewrites the laws. It might take a long time, but it should reflect society's level of acceptance in terms of the outcome that it's trying to achieve. The difficulty is that sanctioned entities can become sanctioned entities overnight. And we saw that with the onset of all the different Russian entities that recently became sanctioned entities. So the challenge really becomes, because with crypto assets, you deal with peer-to-peer. And when you're dealing peer-to-peer, you don't have the centralized party, such as a bank, such as an HSBC, such as a RBS. You don't have that centralized party to help you manage your relationship and protect you from that sanctions position. So if I became sanctioned overnight, and we were doing, I was selling you my pen every month, I sold you a new pen. If I became sanctioned and we were doing that peer-to-peer, you wouldn't have the bank in between us to help you say, come through what you're doing. You shouldn't be doing business with that person. It would be on you. So we all, as individuals and peer entities, are going to be forced to take more responsibility and accountability for the actions that we're taking.
Yeah, I used to say that if you have peer-to-peer transaction, you have peer-to-peer exposure, right? This is and not many people understand this. It's like, why, in banking you have, if you go to, CFI, you get this, let's say solved. But if you, doing peer to peer, which, I hope we're gonna keep it this way, because that's the key differentiator with traditional finance, right?
It's true.
That's the majority of what you can achieve with Web 3.0 is the peer-to-peer transaction. So you don't have anyone who can interfere, but at the same time, that brings responsibility. And I love this analogy to, let's say, many people are saying, the OpenAI, so many people are using this. I think, the OpenAI at the moment is just used for simple stuff and stupid stuff, and in order to get into crypto, especially initially, you have to do your thinking and you have to understand the entire process. You have to build your wallet, understand, private key, public key, how to store it, all this stuff. So there's, huge learning curve, right? Right now, I think, there's a problem with crypto. It's too easy almost.
Certainly with CFI, yeah, with centralized financial organizations that are purporting to do crypto, yeah, they're operating like traditional fintechs, but without the rules of traditional fintechs. So yeah, it's important to lower the boundaries to enable more people to get access, but it's also important to make sure that they're protected as well.
But right now, if we see, and there's a worry that, especially in the US, we're going to see more and more regulations, right? And it's going to be overkill. I think we're going to get to the point where it's overkill. And travel rule, that's something which I know that you spend a lot of time, working with FATF, all these different groups, like I did myself as well, for, I think, 2 or 3 years, right? And where we are working on travel rule. And the travel rule is something which is it's going so much against, crypto, because for every transaction, peer-to-peer transaction, you need to disclose private information, right? So, and I mean, when you read, Credo, you have travel rule solutions. So tell me more. What's your view? What's your perception here?
With the Credo travel rule solution, we're helping organizations meet their obligations. And we're also running a proof of concept with people like Eurofirm, CoinFirm, Chainalysis, Elliptic, all the KYT providers, Merkle Science, Breadcrumbs, all the various different guys, Crystal's in there, Score Chain's in there, everybody's participating. And we're providing this framework that hopefully makes it easy for people to be able to, as an obliged entity, meet their obligations. The real challenge is that the obligations are different in each country. The obligations are different between Switzerland and Singapore and the US and the UK. And an awful lot of the transactions are between those different counterparties. But the travel rule, really, the clue's in the name. It was taken from a US rule that was in place that said, when you send over greater than $3,000 and you send it outside of the US and it travels outside of the US, then you need to provide the information to allow the sanction screening to come into place. Because the correspondent banking network needs to be able to pick that information up and process it appropriately, which is really sensible. $3,000 back then when the travel was written was quite a lot of money. It's not quite so much now. And the challenge with digital is that there's no differentiation between $1 or $0 and $3,000 or $10,000. You end up just moving the scale of the amount of transactions that you actually need to screen. And actually, I think that there are some jurisdictions that have gone massively overkill in terms of the position. So in Switzerland, it's $0 on every transaction. So everything that you do in crypto is going to be transparent, and you need to effectively dox the participating receiving party. Within the UK, it's slightly different. It's like if you're sending within the UK to another UK VASP, the rules are very different to whether you're sending it outside of the UK, which again is interesting. But the rules that you're impacted by are affected not only by the entity that you are and the jurisdiction that you are, but also the receiving party's jurisdiction, because they don't want to be out of compliance either when breaking their obligations. So we really, I think, and this is where I think VATF have an obligation to put more clarity around the guidelines when they come out with their amendments. They need to put more clarity around what the minimum thresholds are that they're expecting. And I think those minimum thresholds should be more appropriate. And personally, I'd like to see them at a much higher level, back up at the $10,000 level, because you don't want to have to go and get your passport out when you're buying a Mars bar or buying a magazine or buying, some kind of a new watch, right?
Especially when you have such good analytics which we have in crypto, right? I mean, you can actually figure out whether this is coming from one seed or different seeds, all this different technology which you can apply, which actually in traditional banking you are not able to do at all, right? So that's something which it's you get more transparency, better technology, and you're still doing this for like zero, which not going to happen. Simply not going to happen for $0. It's not going to happen. And a funny story is I'm a client of one of the Swiss bank, right, and crypto-friendly Swiss bank, and they had the list of approved exchanges. And one of those exchanges was FTX.
Of course. So, he pulled the rug over everybody's eyes.
Yeah, exactly. And so the understanding of where the risk is actually ridiculous. So that's
And that's for me why DeFi is more important actually than CeFi, because DeFi is transparent. You can see it. You're not risk free by any means, shape, or form, but you can see the risks that you're taking because you can see the smart contracts that you're interacting with, and it's an exceptionally different model from traditional banking and traditional finance.
Okay, so let's argue a little bit on this. You have exploits, right? You have smart contracts exploits. You have the oracles exploits. So there's you can argue that where you're putting the money, but at the same time there's risk connected with this very transparent and secure otherwise ecosystem. So that's something which is by the way, the funny part is when someone is stealing this money with all the analytics, where do they go, right? Typically, it was always, and then we're coming back to centralized exchanges.
They go to a centralized exchange.
Yeah, exactly. To the Bahamas, Caymans, all these different jurisdictions, right? When they are cashing out, and it's not the biggest problem of CeFi is then going to the court and trying to sue them. I mean, it's so complicated in this way, right? So I think there's there's definitely of better understanding of if you are.
But all of these different things have digital footprints, right? And we've got in the compliance space, we've got this terminology called source of wealth, and we should be able to apply this source of wealth framework to crypto assets. It doesn't matter, unless they've been minted, they've got provenance. You've got traceability. You can see where they've gone. Even if they've gone into Tornado Cash or some other kind of mixer, you've got traceability, you've got the ability to see the breadcrumbs and to track it down. Whether the technology has been written and exists to be able to do that quite yet, it is different to whether it's possible from a technology perspective. So one of the most exciting projects on the framework at the moment in the crypto space is Aztec Protocol, and they are adding privacy to crypto because you can take an asset and you can use a ZK rollup to put privacy on that asset, and you can roll it up again and you can move it around and you can operate, which is really important for conducting private business and making sure you don't get front run in your activities. And then people, when those assets reach their end destination, they can be unwrapped, they can be deposited, and people can then kind of use them in their world. And we apply the source of wealth principle to those assets. And yeah, again, we've converted traditional compliance framework to new digital assets that maps almost one-to-one. We've got the framework, we've got the tool set. It just needs people to understand a little bit more without being too fearful about this new technology.
Yeah, I think when we start talking about anonymity, privacy, wrapping, there's so many people in compliance which would be like, I remember 2013 when I first time, we've done this conference, and there was like people, compliance conference, one of the largest in Central Europe, and we had this 3 young guys talking about this international trading, sending, in anonymous way, no tracing, there's like people from like compliance and AML saying like, Jesus Christ, this is evil, this is how we're gonna burn, like all this stuff. So what you said, it's actually the same melody, like
it is. It's exactly the same. But we've got many different examples of people winning the Euro Millions, and 2 different people win the Euro Millions. One person, their face is all over the papers. Look at me holding the giant check. The paper prints out where they live. Somebody says, I know where they are. And for the rest of their life, they've got a queue of people outside their door saying, oh my God, give me money. You've got loads of money. You don't deserve that. It makes their life absolute hell. Privacy is really important in terms of being able to conduct business.
I think privacy in general is like critical. That's probably going to be where the frontier gonna happen next, right?
Definitely. So we are living in this golden age of crypto where we have the most transparent asset class in the world available to us. If compliance people can't get comfortable with it today, we've got a really big problem.
So what would need to happen for them to understand this better? So if you, let's say, you have traditional compliance people and you explain crypto, let's put it in this way, right? So what would you say?
I think it's the regulators that need to really kind of come down on things, and I think the regulators need to set really ambitious frameworks that allow people to operate in the regulated environments, to stop pushing people offshore to these far-flung different jurisdictions. And that way we'll get proper businesses spinning up in the UK, in the EU, in the US, that can be regulated and have oversight where it's appropriate. But also make sure that the levels are appropriate, because, if you're selling digital art, if you're selling digital music, and one of the really cool things is some of the platforms that are selling music as NFTs, the revenue streams that the artists make can be up to 1,000 times greater than the same revenue that they would get through from Spotify, which is exactly like them doing a gig in a pub and selling a couple of CDs. So it actually means that these people can actually afford to live and do what they want to do in terms of being creative. We need to support that. We need to support people at kind of ground level, because we're in pretty dark times at the moment, and we need all the growth and opportunities that we can get.
Yeah, no, I completely agree. All right, sounds good. Ben, thank you very much. I think it was excellent. I really like it. Yeah, thank you.
It's a real pleasure, and anything that I can do to kind of help move the needle and help kind of get people thinking about how we regulate this space is really important, because I really believe that crypto is capital markets 2.0, but it's also digital enterprise 2.0, and it's going to solve a lot of the issues with things like human trafficking. I mean, we didn't get down into the kind of the benefits of NFTs in terms of the provenance that you can get. So, it's going to change the world in so many different ways, and I believe it's all going to be positive. I really do. I'm a massive optimist in this space.
So you're still bullish on crypto?
Oh, hugely bullish. Yeah, absolutely. Absolutely. I mean, if you think that the internet didn't make a big impact, just imagine what happens when you get from 2 billion people to 8 billion people. Every business that's on the internet is going to be able to 4x their growth, which if you tell any business you can do 400% more revenue in a space of 3 or 4 years, they'll be so excited. And, it just takes a couple of lines from government to make that a reality.